Hello everyone, welcome back to the channel. Fair Value Finder here, and today we are taking a look at ABBV Inc., ticker ABBV, with current share price in the low 160s. They have earnings coming up next week, so we're taking a look at the year-end financial numbers for 2022 and looking at what kind of growth they've seen over the past few years and what kind of fair value we can assign to this stock. But first, I want to take a look at some of the technicals because I think that technicals play a role, not so much in determining fair value, but they help me determine the time to buy. Shorter term trades, I use some technicals, and I just want to see what's going on with the stock, what the market thinks about it, not just the fundamentals. So right here, we are looking at since 2019, end of 2019 was a low, and it's been on an uptrend ever since. We can see that it's been bouncing off the support line continuously. We got 4 really good bounces, and more recently, as of early 2022, we've been seeing a downtrend starting. I can adjust this a little bit, and we'll see if this continues, especially with the earnings coming up and what that is for the stock. We also have a few lines of support and resistance. I mean, there's a really strong resistance line at the 165-ish level up here. 155 seems to be both support and resistance, depending on what side of the line the stock is on. And then on the lower end, we're looking at like 140, where I don't think it's going to fall down past that much unless something drastic happens. But that's what I look at here. So I'd say if the numbers are good, it might not be a bad place to enter. It is bouncing off this support and trend line here, so may be able to see it drop back down to the 155-ish range, high 150s, and buy in then if we do think it's a buy. So now we'll take a look at the fundamentals of the stock. So here I've pulled together and graphed what I believe are the most important financial numbers for valuing a stock. And so we'll work our way through them. I have highlighted the growth rates with green, red, and yellow for what I think they mean. Green being good, of course, yellow, it's okay, and red is kind of a red flag. And there are a few of those, and we'll touch on why when we get to them. So we'll start with the top line revenue. They've had a nice trend. In 2019, it was about $33.3 billion, and it's up to $58.1 end of 2022, which gives it a 20.4% 3-year compound annual growth rate. And last year's change alone was 3.3%. Not bad, not great, but the 3-year CAGR is great. This last year was fine. I mean, we like to see growth. For cost of goods, so what it costs them to produce those things that they are selling, we do not want to see this number climbing. And we'd like to see it stay level because that would show progress, especially if the revenue is rising. Well, only if the revenue is rising. If we're declining, we'd want to see a decline in this number as well. But we see a 3-year CAGR of about 33%. This last year, it was down about 0.2%, which is good since we saw 3.3% growth on the top line. They are getting better at producing their goods. So that's gone from 7.4 billion to 17.4, which is a massive jump. But also the revenue is up significantly. The one concern would be that this is growing at nearly 33% with the revenue only growing at 20%. But it seems like that was an issue in 2019 and 2020, and it's being brought back in line. So that'll be something we want to take a look at and make sure that it is trending back down. Next is gross profit. So for the gross profit, we are looking at a 16.3% compound annual growth rate. almost 5% this last year alone. It's gone from 25.8 billion to 40.6, and those are good numbers. I mean, I like to see growth in the 5 to 10% range, and this is almost touching it with that last year. The net income, so what's left over after everything, we're getting 14.5% growth compounding, and almost 3% this last year alone. So that's gone from 7.8 all the way up to 11.8. So we're looking at pretty big growth in there as well. And we almost expect that with the top line growing at the rate it was. We're losing some of that money due to expenses and the growth in the cost of goods. But it looks like they've been selling just lower margin products. It's costing them more to produce it, and they're selling it for less of a profit for themselves. And then expenses, they are in the pharmaceutical business. There is a lot of research and development. It's a business where you take on a lot of debt, and you test and develop drugs, and you're trying to get them approved and out to the market. So it's a very tough business. ABBV, personally, I see a lot of commercials for their products. So I know that they're getting out there in front of an audience, and we can see from their revenue that they're definitely getting sales. So it looks like they're investing heavy in the future. So we will see what the future holds for them. But they've gone from expenses of almost 20 billion to 39.2, sorry. And that's very fast growth. I mean, compound annual growth rate of 25% when your top line is only growing at 20 is a little bit concerning. Hopefully they can bring that back in line. Again, that looks like a 2019-2020 issue. A lot of this story looks like there was an issue back in 2019-2020 where they were not doing very good, but they've bounced back since. So bottom line, the earnings before interest and taxes, 10.2 back in 2019, up to 15.7 in 2022. We're looking at a 15.4% compound annual growth rate and a nearly 2% in this last year. It's not bad. It's pretty well in line with everything that we've seen thus far. And then the gross profit. They have an incredibly high gross profit. Again, they invest heavy into creating new products. And once the product is out there, they want to recoup their money. So there's been a downtrend, but 70% is an incredible gross profit. You see a lot of companies that are aiming for 30 to 40%. So that's very good. I like to see that, especially it jumped this last year. It is declining since 2019. Again, it seems like they're creating, it's more expensive to create the products that they're selling since 2019, 2020. Earnings per share, last year they brought in $13.79 per share. I like to see a earnings per share ratio of 20. So that 13.79, it means that for those earnings, I'd be willing to pay up to about $275 a share, which I know is significantly higher than the $160 that it is today, but there are other factors that go into the valuation as well. That's just one. They're very strong on earnings. Assets, we've seen great growth there. Almost 16% CAGR this last year, down 5.3%. Kind of concerning, but when you look at how the liabilities are trending down faster, it's not a massive deal. It could just be that they're selling off some assets to pay down those liabilities, which would put them in a better direction. Liabilities have been trending up, not nearly as quickly, nearly half the rate, going from 97.3 to 121.5 billion. The book value is a steady negative, not something that we really like to see, where there's just a lot of investment here, and the investment might not necessarily make up for the holdings of the company. Definitely looks like people are investing in the earnings and discounting it for this balance sheet. Free cash flow. This is probably the main factor we want to look at with companies, especially if they're paying out dividends. This is what they're going to put into growth, in repaying shareholders, buying back shares. So this is what affects us the most as investors. And we see that it's been growing very nicely, up almost 24% CAGR from 2019, almost 10.3% over the last year alone, outpacing the top line revenue. And that's just a great number right there. So they're making a lot of money, and they're holding on to a lot of it too. Share count, looks like they were buying back share. No, they were not buying back shares. Share count, it looks like they issued more shares in the 2019 to 2021 timeframe, and they've paused since. We really don't like to see a company who is issuing shares, because usually that's the first sign that there's a liquidity issue. Secondly, it's just diluting your holding as an investor. So I'm glad it's paused. If it starts climbing again, I probably would exit and just wait, because they're diluting your position and showing a red flag at the same time. And it's just the number one sign to get out. Shareholders' equity back in 2019 was negative. As we've seen, 2019 seems to have been an awful year. It has hopped since then. I can't give a 3-year CAGR due to the negative number, but about 12% growth in this last year alone, which we like to see. Very nice. And their dividend, they're a great dividend payer and grower. 19.2% CAGR, 7.5% in this last year. So I like to see a dividend yield of around 3.5%. Not too high, not too low. You're getting paid for your investment, but it's not at risk of being cut or dragging the company down. So at that rate, I'd be willing to buy this dividend up to $163, which is right about where the stock trades today. And based on the growth rate, next year, if they grow at the same rate that they have, I'd be willing to pay $175. So right there, I'm seeing about 10% growth in the share value alone, based on my valuations. Return on equity, something that is very good to look at. We're investing all this money into them, but what are they actually doing with it? What are they getting out of it? And there's some great numbers here. Most good companies seem to be between the 30 and 60 return on equity. 60 and above is great, but it could also be the sign of high debt. So that's a number to dig into. And we do see that they have very high debt. Their assets are slightly above it. I'd like to see them pay down those liabilities a whole lot more and a whole lot faster. But we will see how things trend. And now for earnings. Last year's earnings per share were, as we said, 13.79. Their earnings come out on the 27th. They're expected to hit $2.53 a share. They typically come in above the estimates, so I'm sure they'll come in closer to $2.55. But based on the weighting of last year's earnings. Projecting that out, I get expected earnings of $11.04 on the year. Analysts are expecting $11.07. We'll see. But at that rate, for the 20% PE ratio, we'd be looking at $221 stock. So right there, that cuts down my personal valuation of the stock $50. So that is concerning. We'll see how the earnings come in on the 27th and really be able to evaluate at that point. But from what I see right now, I see they're great with dividends. They grow it very well. They have the free cash flow to support it. They have very strong earnings that are dipping almost 30% this year. So that is something that I have to keep an eye on. It may cause the stock to pull back to the 140 to 150 range, at which point we can reevaluate and look at jumping in. I'm not going to sell out on my position. Right now, I am up on my position, I think pretty significantly. Let me take a look at what my average share price was on my holdings, because it is right now in the $160 range. My average cost was $120. So I am up 35% on my position in the stock. Would I buy more? Personally, I don't think so. I'd want to see how things play out over the next 2 to 3 quarters. Would I sell out? Definitely not. If I were interested in getting in at some point, I'd pick up a share or two, just to get that dividend and to have it in front of me to keep checking in on. And then I have everything graphed over here as well, where we can see nothing is out of the ordinary. That's really what we're looking for here. I mean, there's big jumps from 2019 to 2021, but revenue looks pretty good. Nice upward trend. Cost of goods, pretty stagnant. Gross profit looks good, growing. That's what we like to see. Expenses, we don't necessarily want to see growing, but it's nothing insane. And then EBIT are looking good too with some growth. And then for the balance sheet, we don't like to see a negative book value. As I mentioned, I'd like to see that progress to a positive before I really want to invest more. I like the exposure here. Pharmaceuticals are a whole different beast. They rely heavily on drug approvals, so they can see huge run-ups and huge drops, but ABBV, for the most part, seems to be a pretty consistent pharma stock. Here we see the liabilities and the assets kind of going up, down. We'd like to see liabilities trend down and assets trend up. We'll see what this next year brings. And I will put out a video on the earnings when they come out on the 27th. This is the first stock that I chose to do because it's the first of my personal positions, alphabetically. And hopefully you guys enjoyed this. If you own any ABBV, hopefully this gave you some insight. If you were looking into buying some, comment down below what you would like me to take a look at, and I will definitely do a video like this on it. Otherwise, I'll continue through my positions and try and set up some screeners to find new stuff. Until next time, thank you guys for watching.